right, welcome back to another episode of Asset Coach and Tax Strategist. My name is Robert Wolf, and I'm an asset coach and tax strategist. So this video has been it's been happening in some time. I mean, I think this is going to be more educational and informational. So this is not going to be financial advice. It will be educational, informational purposes only. And we've heard a lot of dialogue and talk about Bitcoin. In fact, one of our previous episodes was comparing gold versus Bitcoin, right? And so store of value is what we keep hearing. And gold is has a certain market cap in the trillions, and what could Bitcoin be and all this kind of stuff. Store value, store value, store value. Cardone said it the best is saving should be a storage of funds. So cash should be stored to be able to use in other areas. So Grant Cardone, what his focus is real estate, and he's talking about if you're saving up cash and putting in a savings account with inflation and the lack of hedging with no growth, really should only be a short period of time that money or those funds are in that account. It should be really to store it there to where you store things to go use it and be productive. So cash being an asset. So what we're talking today as an asset coach and tax strategist is the asset class of cash value life insurance. And there's a lot of dialogue and a lot of conversation about this, good and bad. It's like any dialogue, should I buy term and invest the difference? Whole life versus index universal life. We are agnostic to a policy. So if you check down in the description, we've done a video on Insurance 101, goes through high level of what term insurance, what whole life, and what universal life, index universal life is. Go check that out. Okay. But today, really what we want to do is talk about cash value life insurance as an asset class. Okay. No different than you would talk about real estate as an asset class. And in fact, when you look at the two assets, real estate and cash value life insurance, there are significant amount of similarities. Okay. Now the difference though is most people like real estate, it's tangible, and there's such dialogue on life insurance and cash value life insurance. No, it's not a savings vehicle, blah, 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 blah. No, it's a storage. It's an asset to store, to be productive, and to be put into use. One of the biggest concepts that you're going to hear in cash value life insurance is this banking on yourself, this infinite banking, this structure of how can you use this cash value life insurance, the stored cash, to be able to use it in your day-to-day life. Now, in this infinite banking strategy and idea is a lot of the insurance agents talk about how you can buy your car and how you can buy non-performing assets, which is basically what? A liability. It's just a consumerism, right? Buying a car is not an investment unless you're buying some kind of classic car. Right. But a lot of times when you hear the positive things about cash value life insurance, what do they talk about? The lady who started See's Candy, she used her cash value life insurance. Walt Disney used his cash value life insurance policy. So there's stories about how to use this asset to help create another asset. And that's what our focus here is today, is how to use cash value life insurance as an asset to create other assets. We call this our asset buddy system. Now, this asset buddy system is, when you think about it, you work your tail off for that dollar you earn. Whatever you do, whatever that dollar is, each dollar you earn, you work your tail off. Now, as an asset yourself, you are literally the only asset with a brain. So your job is to tell your other assets what to do. Okay. So what do? Well, we got to figure out which assets make the most sense, how to use these assets to create other assets so your assets are working hard to earn a dollar, not just you. It's a duplication of your efforts. This is why franchising exists. This is why direct sales exists. This is why in the legal field. This is why in the accounting field. This is why in the financial planning field, the insurance field. It's all these industries that I just brought up all have main attorneys, main people, partners, and they will do what? They recruit and train lower level, less experienced what? Attorneys, CPAs, and financial advisors, insurance agents. And they all earn a override. Just like a business owner runs a business, manufactures widgets. And what happens with these widgets? He hires employees, and these employees are there to help what? They're all assets. They're all there to help create more widgets in a more efficient manner so there could be more profit for each widget sold. That's it, right? That's what assets do. So real estate as an asset class does the same thing. You store cash. You take this cash, you go buy a piece of property. This piece of property as an investment property, not your single family home. As an investment property, you rent it out, and then all of a sudden creates what? Cash flow, right? Passive income. Okay. And this, everybody says, cash flow is king, cash flow. Well, it's also taxable income. So you really need to understand how to structure your assets to where that passive income can be active income, even though you have other active incomes. Okay. And how do you structure that? And what's the purpose of these assets? Okay. And now with this real estate's kicking in cash flow to you, but you usually go to a bank, right? You get funding from a bank or a financial institution, and you're paying them interest for their funds. Well, imagine if we could use this infinite banking structure and from a global larger level, and we're able to eliminate the majority of the bank, not all of it, but maybe we can eliminate the majority of the bank, or maybe all of it, depending on your situation, because you've built up this storage of cash in your cash value life that is earning 4 to 6% dividends in a whole life, or 6 to 12% in an index universal life, or whatever the case may be, whatever the storage unit is, whatever the policy is to create that cash accumulation within that storage unit. Okay, that cash value life policy. Once you have access to that equity, what do you do with it? Okay, and what if we could eliminate the bank, utilize the cash value life insurance, and basically borrow from your own asset, that non-taxable event, by the way, it's equity, it's a loan. Okay, you take that equity out of that cash value life insurance, you put it into real estate. Okay, you can use that as your down payment for real estate and then use the bank. Or depending on the cash value life insurance, depending on what your structure is, you can do what? You can use that amount into the real estate. And when that real estate kicks out cash flow, what did that asset, that real estate, you do? They borrowed money from another asset. So you need a promissory note. You need a loan agreement, a promissory note between the two assets, acknowledging to the amount, the term, the cost, meaning the interest, that will be paid from the real estate asset to the cash value life insurance asset. By doing that, your interest from the real estate should be where it's paying for the cost of the loan with the life insurance policy. There is a cost, there's interest, okay, plus positive arbitrage, okay? And when you do that in the real estate, you're paying back a loan, which is a expense. So your cash flow is now not taxable income. It's an expense paying back a loan. So now you have both assets as yours, and both are growing and appreciating. They're working in unison, hence the asset buddy system. Okay? This is very powerful conceptual structure of how to do this. You can use cash value life insurance to set up a business. Same thing. And what happens when that real estate pays back that cash value life insurance? Rinse and repeat, buddy. Rinse and repeat. Do the same thing. Now, in fact, you have equity in your cash value life policy and equity in your real estate. What if you were to use equity in both of these assets? Non-taxable event, right? It's taking out equity. It's a loan. And you do take out equity based on how interest rates are. You do take equity out of the real estate, which you do use a financial institution this time. And you take the cash from equity from both of these assets and put it into a bigger asset that's cash flowing more to pay back both loans. You can see how this snowball effect, this compounding effect could occur. Now, one of the things we do at our firm is we also show how to utilize tax planning in the tax savings and tax reduction incorporated in building assets, incorporated in this example of what I'm talking about with cash value life insurance as an asset class. So this is a pretty powerful concept that, the buy term and invest the difference people are rolling over. They're up in arms. They've got their pitchforks and stakes already, right? You got your whole life people and your index universal life people ready to battle. At the end of the day, the most important thing is which one of these assets works best for your situation in a plan that's structured, that gets executed to create that outcome that we talked about. So if your goal is to purchase real estate, it is to grow real estate, then maybe it makes sense if you have enough cash flow, if you have enough structure in your situation, or you have existing cash value life insurance policies and you're not sure what to do with it, this is a great strategy to be able to utilize. Okay. Now, there's risk with everything. So will that real estate perform? Can it pay cash flow, enough cash flow to pay back the loan? Sometimes it may not initially. Depends on what you're investing, what asset it is. It's all based on the structure. So I'm not saying that there's no risk with this. That did not come out of my mouth. But we do understand and have to acknowledge that there are certain limitations and risks to this type of stuff. Like with anything, you can't get infinite amount of money from a bank, right? They're going to do their underwriting. Same thing in this situation. It's based on the cash that you have available in your policy and what that looks like. But here's the thing, the difference between the bank and your cash value life policy is that with the bank, you have a term of a loan, meaning that they're going to loan you money for a period of time, and there's a cost associated to your situation. With the cash value life insurance, the cost is the cost. It has nothing to do with your financial situation. It has to do with this policy, this company for this policy is going to charge this much interest, 6%, 8% for the loan, and it's charged up front. Okay, so they get their money. They're not going to nickel and dime and do it every month for the next 12 months. They just do it right up front in the very beginning. Now, here's the interesting thing and aspect about that is that you can structure this to where the cash that you borrowed out of your asset, your cash value life insurance, can be structured with the right type of policy as if you never took that money out, and it's still earning that 4 to 6% dividend, or that 6 to 7, 8, 9, 12% in the index universal life. Okay, so your total full cash amount could still be earning and appreciating as if you never took the money out, but you do have the money in another asset. These are the types of structures we prefer, because now your asset's appreciating and growing, and you've created another asset, so your cash is actually productive in another asset. This other asset, again, the asset buddy system, is paying back that loan, reducing the cost and the interest of that, but it also adding cash to be able to still contribute and grow based on as if you never took that cash out. Okay. Now, here's the other thing. With borrowing money from a bank, what are they going to do? That term period is that you have to pay principal and interest back. When you have cash value life insurance, what's used as collateral? Well, a bank is going to use the real estate as collateral, aren't they? Or whatever the asset is as collateral. The life insurance company, what's going to be used as collateral? The death benefit. Remember, it's life insurance. So they're going to get their funds no matter what. Now, if you default on the policy, meaning you don't pay it back, there's not enough cash, you stop paying premiums, and all of a sudden it just doesn't work anymore. It's like foreclosing on a real estate. If you foreclose on your cash value life policy, the borrowed money will be considered taxable income. You will receive a 1099. Okay. But as long as that policy is in force, as long as you're paying the costs and keeping up the real estate, so to speak, same thing with cash value life insurance, as long as you're keeping that up, paying for the expense of the policy, the life insurance, the death benefit is going to be held as collateral. And therefore, when you end up passing away, if you never pay that loan back or interest, that amount of loan and interest will come off the death benefit. So your heirs would get the net difference of the death benefit from the loan amount and interest, or what wasn't paid back, the net amount would go to your heirs income tax free, most likely, depending on your situation, net worth, and estate, and all that kind of stuff. There could be some structure, estate planning issues down the road. So this is not tax advice. This is just basic overall education. So you don't have a term period. So you can, when you create your promissory note from your cash value life policy, you personally, or whatever's the owner of the cash value life insurance, yes, there's three parties to a life insurance policy. There's the owner, which could be different than the insured who the life insurance is on. And then there's a beneficiary. You cannot have somebody be all three, but you can have somebody be two. You can have an owner and a beneficiary be the same person, or you can have an owner and the insured be the same person. Okay. But depending on how you structure this, whoever the owner is the one who puts the promissory note with the real estate in place. So if you're not comfortable with the 5-year repayment because of the cash flow of the real estate, then do a 10-year. Do whatever you want. Okay. You just have control over the payment on that. So back to my original conversation is that there's not enough cash flow in the real estate because you do have to put more money into it, right? You have to get it up and get it ready to start renting out or whatever the case may be to start creating that cash flow. Then you start the payments to the cash value life insurance. You can structure all that in a promissory note. It just has to be written, documented. Both parties, the managing party of both assets needs to sign the agreement as both parties understand. And quite honestly, you could be the representative of both assets, but they do need to be structured, and it does need to be a structured setup for the IRS to acknowledge that, or to the legal system to acknowledge that this is a real contract, which is a promissory note. Okay. So again, we're not giving financial advice here. We're not giving legal advice. We're not giving tax advice here. All we're doing is saying, hey, here's how these assets work. This may work for your situation. Reach out to your team if you have a team. If you don't have a team, reach out to us. See if this is a good fit for you and your situation. And from that aspect, this is the way the asset buddy system works, and how cash value life insurance is an asset class, how it can be utilized to be able to grow your wealth exponentially in a more compounding effect that you have control over, not just hoping and waiting for the whole life company to change the dividends or for the indexing of the index universal life to be able to have better crediting or participation. Oh, I hope the real estate gods allow me to make. You have some control in this whole structure, okay? Because again, you are the only asset with a brain. So let's use it. Let's give purpose to these other assets. So if you like this content, give us a thumbs up. Go ahead and subscribe. Add a comment down below if you have any questions, specific questions. Love questions, because that gives us content for the next videos and being able to help provide the content that's available. Again, check out our other episode on Life Insurance 101 to see the overall explanation of what term, whole life, and universal life policies are, kind of a high level overview if you haven't seen that already. And thanks so much for your time. I appreciate it, and go have a great day.